Welcome to Trading Nation. I'm Eric Chemi. A banner month for stocks. The S&P 500, the Dow, and the Nasdaq seeing their best August in years. But our next guest is waving a warning flag. Sounds scary. Lakshman Achuthan is the co-founder of the Economic Cycle Research Institute. Lakshman, did I get your last name right? I hope I did.
Yeah, you got it.
Okay.
Nailed it.
Okay, so I know you've brought a chart with you highlighting some of the risks going on here, maybe a correction that you're highlighting. Talk about what investors should be scared about.
Well, I think just managing cyclical risk is what they should be thinking about, at least from my point of view. The chart that I brought shows the equity market, the S&P 500 over time. And what's unique about this chart is that we've marked off the slowdowns in the economy, the so-called growth rate cycle slowdown. So the shaded areas are when the economy is decelerating. And that is a period of time when the risk, more often than not, is that you're going to see some sort of correction in the order of 10 to 20% downside moves in equity markets, equity prices during those growth rate cycle slowdowns. So it's kind of a yellow signal for the market. And you could see back in 2010, we had a 16% decline. It took on the order of I think 7 months to regain what we had lost there. Then in 2012, we had 10% and 7% decline. 2015-16, you have a 12% and a 13% decline. And then come all the way to this year, in 2018, and back in February, we saw a 10% decline. It took about on the order of 7 months to recover. What's operative today, even though we're at all-time highs in the market, we've recovered, is that the growth rate cycle downturn is actually still going on. It's not over. And we will see some slowing in growth going forward, which means that the kind of the yellow light, the warning light for possible corrections is still operative. We don't get a green light until leading indicators turn back up. One last point, ECRI publicly releases a weekly leading index. It's followed by a lot of people. We put that out on businesscycle.com. And today it happened to go to its first negative growth rate since early 2016. So it's a directional call. Again, there's no recession, it's a slowdown. But the slowdown is, I think, very real and will become more apparent in the coming months.
So, but you mentioned this, we're at all-time highs here. I mean, everyone is seeing more green days than red days. Consumer confidence is high. Workers are satisfied. The unemployment market is very tight. It's very good for workers. So I don't really understand. I know you kind of went through all this, but I'll ask it more simply. What effect do these all-time highs, what do they have on your bear case here? Does that concern you a little bit?
Well, yeah, you'll see on the chart that the market is often hitting all-time highs just by virtue of inflation over time. But during these growth rate cycle downturns in the economy, the market corrects or kind of goes sideways and takes a while to get its legs under it again. So I think that's the real issue for investors. When you turn to the labor market, I expect the unemployment rate to hit, half-century lows in the coming months. Just by virtue of a little bit of jobs growth will move it down, given the way that the numbers are calculated. And when you look at consumer confidence, yes, they're the highest. I think the Conference Board reading is the highest since the fall of 2000. And that's true, but it's driven largely by so-called present conditions or current conditions, which is not a leading indicator of the economy. And of course, some will remember back in the fall of 2000, the market didn't do so well afterwards.
All right, so finally, what should investors expect when they return to work after Labor Day? We know September generally the worst month of the year for the market. So, I mean, are you just going to get lucked out here because it's September? So you're saying, oh, here comes a correction, and then September takes care of it for you?
Well, it could happen, but again, we're not timing some correction. We're just saying that the risk of corrections on the order of 10 to 20%, those go up during growth rate cycle downturns, and we're still in one. So we still have a yellow light. We look forward to giving a green light, but it's only when the leading indicators turns. And as I've said, they've actually been going to the downside. So I would just say you have to manage your cyclical risk. It's not an all clear signal here.
Okay, Lakshman, appreciate it. Good insights. Appreciate the commentary. We're going to have to see what happens here in September. Thanks for coming on Trading Nation with me.
Thank you very much.
And thank you for watching Trading Nation. I'm Eric Chemi. We'll see you next time.
Hey traders, did you like that video? There's more where that came from. Scroll down and click on the links to the right of your screen. We publish new videos and commentaries from our experts every day. And don't forget to follow us on Twitter @Trading Nation.